Hello there, welcome to Moments with Lil. Today we're going to be talking about, again, lending. As always, my name is Lil and I'm from LA Mortgage and also represent Frontline Heroes. Let me introduce you my guest first, Kevin Peranio from PRMG.
Hello,
He's
how you
like
doing?
the down-to-earth dude guy. He'll just hear and talk to me.
Yeah, thank you for having me on your show. I'm with a local lender here in Corona, California, called Paramount Residential Mortgage Group, and I'm the chief lending officer and one of the partners.
Well, thank you for coming here. I would like to, the reason for me to, the reason that I invited you here is because I want to make a video that would benefit also the brokers, the local brokers, and also the local buyers. Because nowadays we come across with, we live in California. Everything is so expensive. And by the time they get their paycheck, they have the money, but yet it's already spent, right? So I would like to find out what would be we can talk about the product that, what would you recommend
Sure.
for people who doesn't have money, but they make so much money?
Sure.
Does that make sense?
Totally. I mean, I moved my family here 4 years ago to California.
That's so
and
brave of you, by
it
the
is.
way.
Oh, it's expensive here.
Yeah.
I mean, it's you think about normal teachers and first responders and how they are able to afford to live here. It's very tough, and so community lending is super important. So I think if you're an originator and you're in the local community, you have to find ways to diversify your product mix and your offering.
Yes.
So we're a privately owned lender, and we've been around going on 19 years, and we are definitely growing, and we take risks. We actually we have a nice balanced portfolio. We take some risks on some loans that maybe banks would turn down, and maybe some hedge fund backed companies would turn down because they don't want to take the risk. But the reality is, if you can help someone get into their home, the odds of default are the lowest they've been in likely history. I mean, especially opening a door in Southern California, if you can get in, then you can lock in your price and fix your payment so your rent doesn't keep going up every year, right? I mean, rent goes up on average 5% a year. And if you can lock in a payment for 30 years,
Yes.
that's a huge win. And it's a forced savings plan because now you're earning equity in that home. So for us, the biggest hurdle to homeownership is the down payment.
Yes.
We have a lot of down payment programs that we really push at PRMG. And, there's some that are specific to California. CalHFA is one of them. It's a great way to get into the home without having to save up, a lot of money. There's a huge myth that you have to save 20% for a down payment. And that's just absolute bogus. You can literally get in a home for, zero down on the house and then just pay for certain closing costs.
Can you elaborate how this CalHFA works exactly,
Sure.
and with the closing costs and what exactly are typical out of pocket for the borrowers?
It depends on how you structure the loan, but you've got you have the ability to do. I guess the easiest way to explain it to the public is like a silent second lien. That's probably the easiest way to explain it. And so there are government entities that will help you with your down payment. So typically on your standard loan, you're putting 3.5%, 3 or 5% down, somewhere in that range, and you can have that subsidized with a CalHFA loan. So you're really just coming in with minimal closing costs. I mean, I've seen people come in with just a few $1,000s on a $450,000 house. That's tremendous. And think about what the myth is out there. The myth out there is that person needs to bring in, what, 90 grand? I mean,
Exactly.
and
it stops them because the public doesn't have any knowledge,
right?
And then they would think like I come across with that actually last week, and then they said, do I have to have 20%? I said, no. If you have 3%, if your credit is good, 3%, or if your credit is not so good, 3.5%, but the rate's gonna be high. Is this like, and also the myth, there's always myth because people, what they perceive, what they read in, what they gather in the media. I mean, leave it to the professional. It's always better to consult, right?
100%.
because they talk about, they read it and like, oh, but FHA is expensive. No, I mean, like, if you do an FHA, I just closed, like 3.5%, no, not 3.5%, all expenses paid, right? So because of this mortgage insurance, that's effective rate of what, 4.3 or something like that. But the score, it's not good. So if I were to convert it to conventional, you're looking about almost like 6%. So why would you not go to FHA? I mean, don't reject that.
Yeah, no, I think there's a lot of myths out there. The one about the 20% down comes from, if on a conventional loan, if you put 20% down, you don't have to pay a mortgage insurance. And so, there's that little extra piece that's a monthly payment. First of all, paying mortgage insurance isn't bad. I mean, cash is king. Why would you want to put more down on your home? And I think to take it even deeper, it's a lot of people look at owning a home as a debt. And so there's still like this fear of like, I'm going into debt. And then they always look at that number like, I'm going into $400,000 in debt. That's like a daunting feeling to you. But
it is.
But if you get with a local originator that is an expert, and they explain to you from that trusted financial advisor role, you say, owning a home is a financial vehicle. Owning a home is not just about debt. Owning a home is owning an asset that appreciates over time. And so you're going to pay rent anyway, right? So, I mean, unless you live on the street, you're going to pay a monthly payment. So at least pay it towards an asset that appreciates.
It's yours.
Do you know, including the Great Recession that we just went through, all right? 07, 08, 09.
Oh my God.
Looking, which is a scary thing.
Very scary.
If you look back 30 years and you include that worst downturn, which was a true bubble, which we don't have anything near nowadays, appreciation is still an average of 5% a year. You can't put money in a checking account and earn 5% a year. And you're paying rent right now to a landlord, and that property is earning 5% appreciation in value. So I just, explaining to people, it's not a debt. It's not this massive number. You don't have to put 20% down. You can get zero money down. There are local experts right in your community that can help you out. And that loan, that CalHAFA loan that we do, that's not the only down payment assistance program. We offer one called Shanoa, which is backed by it's backed by a Native American tribal fund. And,
do I have to be a Native American?
No, you don't. You don't.
I was like looking at that. I'm like, oh, maybe it's only offered to Native American. I'm like, I'm not a Native American. I'm Asian, as you can see. So how does it work, the Chinoa?
Well, it's very similar to CalHAFA. It's a down payment assistance program. It's another program that you're able to help subsidize.
When you say subsidize, a silent second, does it mean that you have to pay? Or how does it work?
So if you're in the home for, let's just say 5 years, right, which most people intend to buy and stay there, there is no payback. It is a lien on the property. And so, that's how most down payment assistance programs work. So
5 years.
It's typically 5
okay.
years. Yeah.
So
that's a standard. Some there are none. It's a true gift. And some are longer, but not much longer.
So 5 years, you don't have to pay?
You're just making your mortgage payment every month, and then the fund has been paid back, and they're like, all right, this person doesn't owe us anything. So those are there's different approaches from.
So you actually paid the second?
It's part of your payment.
Okay. Oh,
yeah.
Okay.
Yeah, because your interest rate's a little bit higher, right? And to be fully transparent, I mean, there's discussion like, is it right to call something a gift, right, to pay for someone's down payment when you're paying a little bit slightly higher in the rate?
Okay.
But you have to understand, I mean, you're talking about people that can't get into that house at all if they weren't think about what if it's like $20,000? I mean, some people can't save $2,000. It's so expensive to live here. And so someone would gladly make that payment, even if it's a little bit higher, to get into the door to begin with. And then they start appreciating. And, we have, the other side of the equation is there's a major undersupply in housing right now. There aren't enough homes for sale.
Yes.
So prices are going up.
How are they able to afford it either? Like,
I don't know.
I'm surprised. I mean, we live in California. It's the most expensive piece of real estate. And
crazy.
you were talking about the home ownership. I remember way back 1988, you can buy a beautiful house in Chino Hills for like 180,000. And then now, 2020? So how old is that? Anyway, it's now selling for 1.2.
That's nuts.
So, I tell people, I mean, it's so expensive and they don't want to get into it. But you know what? And then, well, should I wait? I said, well, don't make it an investment. It is through investment. But what I'm saying is like, this is your home. So even though the market crash, it's still your home. And no matter what, real estate will go down, but it will never be the same. It always goes up.
Yeah, over time, over history, the average appreciation has been 5% a year, including some of the worst recessions our generations have seen. So again, if you're going to live under a roof and pay rent, you're paying the payment anyway.
You're making someone else ownership.
You're making someone else rich.
Exactly.
And you need to do that for yourself. Don't rent. It's just a sucker's deal. Over time, that financial asset is yours. And like you said, it's not like a stock. Like Tesla stock today. Although you can drive one of those, but you can live in your home. So you can make that payment, and then you come here and you can make it your own. And of course, you want to move. You don't have to sell it. You can always rent it out.
Yes.
There's always renters.
Yes, there's always going to be renters.
Did you know that 90% of millionaires got it through real estate?
Oh, definitely.
90%.
It's the only for sure that get your money worth actually, and more. Basically,
That's right.
yeah.
That's right. So whether it's a down payment assistance program, whether look, we do true no overlays at our office. You were talking about this earlier. We sell to Fannie, Freddie, and Ginnie. Let's say you had a Puerto Rican borrower that had Puerto Rican stamped tax returns from El Departamento Hacienda. We'll take that. Like, we'll look at their tax returns from the prior year from Puerto Rico. Not all lenders will do that.
Yeah.
We offer I-10 financing. Unconventional.
You do. Okay.
Not for government. HUD's been very clear about
Yeah,
that.
yeah.
But unconventional, we offer that.
Oh, nice.
You've got a individual taxpayer ID number. Just because that person doesn't have their citizenship yet, they don't deserve a home. Hell, they probably work harder than we do.
Yes.
So
I've
it's like
encountered a lot of this.
and the amount of saving that the immigrant population does, it's like off the charts, higher than your average U.S. citizen. So
Wow.
there are borrower programs for I-10 borrowers, as we like to call them.
What's the percentage on that down payment for the I-10 borrowers?
So it's typically 5% down.
Really?
Yeah, it's just a conventional loan.
Wow.
Yeah.
Okay.
It's just a regular old Fannie Mae
Seriously.
loan. Yeah.
I did not know that. See?
Yeah.
I mean, without sitting with you, I would not even know, because I come across with that. I'm like, we need your green card.
Yeah.
So now you said they don't need to have a social security, just I-10, and then that's perfect.
Well, it's very interesting because, we're in this age of technology, and everyone is looking for that easier, frictionless experience, and that is great. I mean, there's some fantastic lenders out there that are making it easy to do business with them, and but let's not forget, when you develop in your community. Have you ever heard of what's called a super fan?
A super fan.
A super fan.
Okay, what does that mean?
Imagine if you took someone with no money down and
Okay.
you helped them get into a home, and they never thought it was possible.
Yes.
Right?
Yes.
So they become a Lil
Yes.
super fan.
Yes.
This is someone that raves about you on your behalf when you're not around.
Yes.
Those are the bars that are the most appreciative. They scream from the rooftops. They're like, you have got to call Lil. You have no idea. I thought I could not. I remember the story I shared with you a couple weeks ago about the bar in
Yes,
Houston,
yes.
who was a cancer survivor
Yeah.
at age 30, had never slept in his own home his whole life. He'd always been either on the
She was
floor
so
or
grateful.
and this person was so grateful. A broker of ours in Houston was able to send a loan to us, and we helped this bar. And that person was so so thankful and just blessed. And you know, it's just remember when you're doing loans, not every loan should be the slam dunk easy refi, which there's a ton of those right now, and
very
everyone's
much.
getting their share. But you know, just be intentional about doing a loan that might be something you would have turned away before. Some people even spend the time repairing credit, you know, and helping someone.
I do. And that is awesome. I do have a lot of those super fan actually. I'm gonna start knocking on them because, like I said, 2020 is gonna be my year.
Yeah, it is your year.
So I'm gonna be like
Year of the rat.
I am a rat.
Are you
no,
really?
Not that. No, I'm not. I'm not. I don't believe.
I'm a dragon.
Oh my goodness.
76.
So let's not go there, okay? Yeah. Anyway, no. I'm so grateful actually with those super fan. You're right, because in this business actually, because there's a lot of brokers out there. I mean, not we promote brokers are better. It is brokers are better, but there's also a lot of brokers there that are bad for the community, because all they can think of, it's not a good intention for the buyer or borrower, because they think about, oh yeah, we can do this, and they give them a bad loan, and because it makes more money for them, right? So basically, I don't agree with a lot of brokers. So there's a lot of brokers who's actually in for the community, but there's also a lot of brokers who's going into the system. Okay, this is my problem, so you stop me if I'm wrong. I've been doing this for more than 3 decades. And I came through or experienced a lot of it, like people come and go, right? So we have that crisis about all the program, Nina, all of those things. That's why the appraisal, that's why the market collapsed, right? Yeah. So I don't want that to happen. And because right now the market is really good, and a lot of people, we're enticing everyone to be a broker, and I feel like everyone is going in, and we need to filter them out, because I wanted to make sure that the broker who's going to be here are the brokers actually benefiting or for the borrowers. Because I don't want them coming in because the money is good. I mean, yeah, don't get me wrong, the money is good, but you have to remember, we do this for them, for the community. Not for your own.
Well, if you do what you love, the money will follow. I'm a big believer in that.
I am too.
And to give all credit where credit's due, there's a really great social media marketer and influencer named Brittany Hodak, and I saw her speak last year, and she's the one that talks about the super fan. So I don't want anyone to think that I made that up. I probably should have given her the plug earlier, but yeah, look, there are hundreds of thousands of originators, and there's over $2 trillion in loans.
Yes.
And so, with that abundance mindset, there's gonna be some bad actors, and there's gonna be some people, and then there's gonna be some good actors, but maybe they're just solely money driven, and that's okay. Like, it's what they're about, but there's enough of a market for you to carve out what matters to you and what gets you going. And again, I mean, if you're being mindful about doing programs that you don't, you want to make sure you don't put someone in a house that's going to cause a market crash. That's a very responsible feeling to have as a broker. I can tell you from the lending side that the amount of defaults are relatively low. The loan quality right now is the best in history.
Because the economy is good.
The economy's good, and it's right. And that is literally, I mean, homes are appreciating. So why would you want to walk away? You're walking away from equity. Like some markets are appreciating 11% a year.
Wow.
Think about that. You can't make that kind of money anywhere, unless you got lucky with the Tesla stock. But
you still, yeah, I think you better buy that Tesla stock when you get home.
I know. I'm kicking myself. Yeah. But I will say that fraud is still out there. We are still seeing fraud, and it's few and far between compared to the past. I was in South Florida, from 2003 and through the crash, so I saw it firsthand. I saw a lot of it. I saw the straw buyer scams and fake documentation. But the process now for getting information is so advanced. I mean, like if your borrower is willing to enter their bank account number and name, you can pull data straight from the bank and input it in the system. I mean, you don't even have to ask them to a bank statement, so there's no bank statement to go fake. Same thing with pay and income history and verification and tax returns. I mean, 4506. Remember,
so easy.
I mean, it's like, I want to say, I had a small lender called North Star Lending in between First Magnus and where I work at PRMG, and we were focused mostly on wholesale, and we also had a retail group, and we were in South Florida, and I saw this trend where borrowers would sign the 4506 at the table, and then the lender we would sell it to would execute the 4506, check the income, and then they go, "Hey, your VOE is BS." So,
oh my God.
So I'm telling you right now, like I ran the very first wholesale lender in America to pull 4506 up front.
Wow.
I was in like ground zero for fraud during the heat of the crash. I was like, we had just gotten approved with Fannie Mae to service loans. It's like, I'm not going to ruin the chance to work with Fannie Mae. So we started pulling 4506s up front on every broker's deals. 2/3 of our business disappeared overnight.
Oh, wow.
Because
see, this is what I'm talking about.
Yeah.
I mean, I know it's going to be very difficult not to commit fraud, but
is.
still out there because the information, it's easy. It's now easy to double confirm every information, and I believe in that one.
Yeah.
And then when the market crashed, I really never participated on that one. I'm always like the conventional, person.
You didn't do the ninja loan?
No, I didn't.
You see that?
Oh, that was so
From the
funny.
movie?
Oh, no, I didn't. You know what?
Too big to fail?
Yes. You know what? We have one loan officer, LO. He made like $1.3 million in 6 months.
Oh, wow.
Yeah. So what he did is like, he sells, he asked someone to buy that house and everything like that under their name and everything, and then got the loan, no
Straw
income.
buyer.
Yeah, exactly.
Yeah.
And then they keep turning around. So no, I never participated on that.
The straw buyer scam is definitely something that's still out there. We've seen a little bit of it, not too much of it, but it is something that's still prevalent, unfortunately, and. The good news is that home
all
prices.
All of them are in the jail.
Yeah, well, trust me. Yeah, people get turned in now. There's a whole system.
Yeah.
I mean, look, I'm not a big regulation guy. I'm not a fan of Dodd-Frank, but one thing that came out of it that I think is helpful is much of a pain in the butt the NMLS is. There is a central registration for all originators. And I think bank LOs should be forced to be on there as well. I think it's kind of unfair that just because they work for Wells Fargo that they're not gonna.
No,
they're
actually.
not. I know, but they're not gonna commit fraud because they. We saw what happened with Wells Fargo, right?
Exactly.
So, and I know they're cleaning up their act there too. I mean, but my point is there's a central place to report bad actors when they do certain things, and that's only helpful for all of us. And so, but I think where I see where the industry has potential headwinds is when the economy goes into a recession, and it's bound to happen. I mean, it's just part of
what goes up
comes down. That's it, or slows down.
Yes.
And so when that happens, some people will lose jobs, and those people, if they can't find a new job, that's where you're likely to see some defaulting. But it's such a low percentage of the market when the people that are doing loans now are having their income fully vetted and they're having their income verified. And so, but having said that, when the economy is in the recession, the Fed will cut rates. And I mean, can you imagine rates being lower than they are today?
So how low can it be? How low can you go? What's the lowest rate that you actually see? Or I originated?
I see 3 1/8.
That's the lowest?
On a 30-year fixed. Oh wow. Right
okay.
now. There's some arms.
No, I mean in the years that you doing this.
That's it. I mean.
That's it?
Yeah, that's
oh
as low as I've seen.
Really?
I mean, you could do. There's some arms that are lower.
I
in the high twos.
I did like a 2 1/4.
Oh my gosh.
On a 30-year, it's a 30-year. Yeah, that was
15?
no 30 years.
No. When?
Yes, that was probably back. I would say 1998,
Oh, okay.
isn't it?
I know.
1998 when the
so
market crashed and everything.
I got in the business in '01.
I'm sorry. God,
So, yeah.
you would say like,
Well, it wasn't my first job out of college, so.
yeah, no, it's like 2.25.
Wow.
Yeah, when I started, actually, the reason I started with the real estate, I studied real estate actually, and we give loans to the loan officers, and then they will quote them 9.5, right? And then when we close, they will give them 13%. I'm like, what the F? I'm like, these people are scum. And that's how I feel about them.
Yeah.
You know, they were scum. I mean, like they call it a switch and bait, right? So they quote you all of that because back then, you know, lock is not offered unless you're ready to close.
So a lot of the regulation now doesn't even allow for bait and switch in the paper world. You know, you have to disclose with the loan estimate up front. When you lock a loan, the disclosures have to go out, within 3 days, showing the borrower, hey, this is what you're locked in at. Gives them time to review. There's time to review the closing disclosure as well. And so, there's a lot has been, I guess, rid of in this industry. It's still possible, if someone's being lied to by their trusted advisor, there's potential for that. But bait and switch is almost completely eradicated from our industry just based on the regulation that's out there. And you can close and start to finish 7 days if you waive the right to the appraisal or don't have an appraisal, or 10 days. I mean, literally, like where this industry is going is from start to finish. You're closing loans in 7 to 10 days.
I closed 2 days.
Isn't that amazing?
You
were clear to close in Tuesday.
Yeah.
But you can't actually close.
No, that's true. Yeah. That's true. Clear to close in 2 days.
Oh,
so
clear to close.
like,
yeah. Clear to close all depends on the quality of your file. So
exactly.
Yeah, I mean, we see.
That was pretty awesome.
Yeah, we see them. We see them as well. People send in, clean files and they have it complete and they have everything they need. You don't need an appraisal.
Exactly.
I mean, that's those are all, fast. Remember the old fast and easy?
Tell my broker brothers and sisters about PRMG, because some of them never heard of PRMG.
I know. It's crazy,
and we're
right?
going to change that, right? We're going to change
you.
that. Yes, please.
Yeah, thank you for giving me a little time here. We're, it's mostly our fault that, we don't promote ourselves more than we do. But, we're a privately owned lender. We're in Southern California. We've been around almost 19 years. We have a wholesale channel that's been around the entire time. And, we're capitalized like a regional bank. We sell loans to Fannie, Freddie, and Ginnie. We service some of our own loans. And, our value proposition is, built by originators for originators. So we try and find a way to get deals done for anyone that asks for our help. That includes service levels, having an underwriter with their full mind around the file and you being able to get in touch with that underwriter, potentially having the same group of underwriters that you get to work with to build up some consistency. We have outside account executives that are in the communities. They're just extremely well versed at programs and guidelines, and they're just ready to take your call and help you out and serve you. And that's just who we are as a company. We're there's that feeling that we're right here in the community with you, and I would love to go cook with all of our broker friends out there,
No,
but
that's my segment.
I
okay?
know.
Don't give it away.
Yeah, right. It's very cool.
It is very
It's
cool.
unique.
Yes. And one thing that I like about PRMG is the lender layover. So you guys, I have experienced it already. Maybe 3 times where if I am short of 2 points of score, and the jump on the add-on is about 1.5%. If I have a 638 FICO and your 640 is that's 1.5 on the add-on the pricing, right? And you guys give price exception So is this something?
Yeah, if you think about the mindset and the way we operate, we try and use common sense. And so, if you submit a file one way and then midstream or even at the end something changes, I mean that's not. There are things that come up in this process. Doing loans can be messy.
It
They're not
is.
all easy refis, and we love those too. We're very good at those. But we try really hard to do some of the tougher stuff, some of the stuff that you find in the community, and we also, because we sell to Fannie, Freddie, and Ginnie, we can make business decisions. We can make exceptions on certain overlays that some lenders have, and it's just all about building a relationship. And look, some of the deals we do are tough deals. You may compare them to your other experience where you're getting a deal closed, clear to close in 2 days. But if you're doing a Cal HAFA or a Colorado HFA loan, and
Can't
there's
do that.
and there's 250 emails going back and forth between us and the client. I mean, there's obviously there's some deals that are just tougher than others, and
Definitely.
but we're willing to accept the challenge. I mean, we're not going anywhere. This is what we do. We love what we do. We're deeply rooted in all these communities together with you. So
I feel guilty. I feel guilty. Like I'm only give, the hard ones to you guys, the exceptions. So, but you're
I get it.
here because I got, with the time frame. Like, that's why I pulled back. So, but
that's a good point.
That's why I pulled back with the time frame because
Sure.
people just want to go faster.
I get it.
Closing and everything. So, but there was a reason behind it.
So, I think you think I don't like doing things faster? I mean, I don't even use cabs anymore. It's all Lyft, and then, if I have to, I'll use Uber. But, everyone wants a frictionless, easy experience.
Yes.
And the thing about that is you start to get kind of wrapped up in only focusing your business on those types of loans. And that's not true community building. And the other thing is sometimes when you think someone with a 760 bar and slam dunk refi, you think it's easy, but then something shows up that, all right, you need a little hand holding, you got to kind of get out of the assembly line track there, and you got to find a way and put your head together with someone to fix it. And that's where we really excel. So, don't feel bad. We love one loan a year or, one loan, every week. It doesn't matter. We have clients, we have some clients that send us, 1,000 loans a year. We have some that send us one. And so it just depends on, that relationship and building that up. So because we're privately owned, we're watching our business and we're growing. We don't have endless amounts of money. But last year, I think like everybody else, we got backed up starting in August, and then September of 2019 was probably our worst on the turn times. And I want people to understand there are a lot of lenders that go out and announce a pricing change, and then they get loaded up, and then the natural reaction is, okay, I'm getting slammed with loans, so let's raise our margins and make our price worse. And we at PRMG think that's breaking trust. And that's basically lying to your client, your partner. And so for us, when we got backed up in August and September, we kept our rates the same. And so price consistency is something that's super important to us. Like, we can't get backed up in turn time because we're getting too many loans, which is a good thing. People are trusting us more, and we're hiring feverishly to get more underwriting support. But then we're going to break that trust twice and then jack up your rates on you. We can't do that. So price consistency, I got to give Gary Malice, who's one of my partners at the company, Chief Capital Markets and Strategy Officer, price consistency is so big with him. We are very consistent in what we offer. And in that way, when we get the underwriting staff to come back in line and we get our turn times back where they need to be, like we did in October, we go back and say, hey, look, we never raised our rates on you. We got behind, we were up front, we published our turn times, and so now we're back. And so give us a try. So this year, we've been hiring underwriters starting in December and January, and we're just trying to stay out in front of it. And it's not always easy. I mean, we may double this year. If we double this year, does that mean we're going to double our staff? It takes time to scale our company. And so just know that we're working very hard, and we own up to the fact that our turn times got backed up in August and September, and but they're a lot better now, and we haven't changed who we are at our core. We're still trying to find ways to get deals done and serve you.
Wow. I mean, like I said, if you guys don't know PRMG, they will pretty much work out whatever you need. And that's one thing that I really like about
try.
PRMG. So the fact that, you need to put your name out there. You're such a cool dude.
We try.
Yes,
We
you
try.
are. You are such a cool dude. So everyone is talking about, and even like, look at you. You're a busy guy, right? And you have like a big, company to run, and then you chose to be here, and I'm grateful.
Oh, I appreciate the invite.
And then also,
You invited me to your home to cook. That's a special request.
well, I know, because
That's
now you
pretty
can
cool.
cook, so right, so you can do anything. So you can possibly not only you run the company, but now you can cook. So, and then also the fact that everyone is talking about who is PRMG, and I want them to know
Sure.
who you are, and just promote yourself. And
It's hard to do, you know that.
I
right?
know, but I
That's
think
not we're not shameless self-promoters. I mean,
well, I think because a lot of you guys are you're up there. You hang out with a dude who is a really good originators, and they know. So promotion from them maybe will be great as well.
Sure.
But the fact that like you're in that forum, and then who does that? I mean, like there's a scenario, and then you actually you're the hands-on guy. I'm like, okay, let me take care of that.
We try.
So that is pretty awesome.
Well, we got some cool things coming. I mean, let's be fair to our team. I mean, we have 2,100 people that work their butts off, and we have our two founders, Paul Rosso and Robert Holliday, who are originators. They literally were doing loans right here in the high desert. Mm-hmm. And we have a saying: "It's built by originators for originators." We think about the originator first. We're not perfect. We're not the best at every single thing we do, but when you think like an originator, who's trying to do a little bit of everything for everyone,
Yes.
it's hard. That's a hard task.
Mm-hmm.
If we just focused on, like just second liens or, just this product or just the fix and flip, I think our life would be tremendously easier. But that's not the point. Like easy is not the point of being an originator. It's a hard job. It's a stressful job at times, and so our challenge has been one to try and do a little bit of everything for everyone. And that is a very hard business model to scale. And we're not, bad people for not being the best at every single thing we do, but we certainly have good intent. I will say that the 2,100 people going on 19 years of being here, we feel very blessed and very fortunate to be in this industry at this time. And we're not going anywhere. I mean, we're here to serve you. We're here to kick butt together, whether it's, one loan or 1,000, doesn't matter what it is. We treat every loan, like we got to earn it. This could be our last loan from this client. We're not taking things for granted. And so
that is awesome.
Yeah.
The last question that I'm going to ask you, a lot of brokers are asking,
Mm-hmm.
because the fact that you have a retail
Mm-hmm.
division, how do you separate yourself from the wholesale?
Well, I just think
Well, how do we protect our client?
Well, that's definitely, it's two different questions, and they're great questions. So remember, I mean, someone working in the retail channel has put 100% of their faith in us.
Yes.
Okay. And so they're an originator just like you.
Yes.
I mean, think about that. Like, think about the burden we have to make that person happy. We have to do everything for them. That is a tall order, right? And so the broker channel is a different business model, completely different business model, different mindset, different everything. And so we serve that as well. And so what's interesting is our TPO business is 50% of our business we did last year. Wow. So we have about 12% is non-delegated, a little bit of delegated correspondent, and the rest of that 50% is wholesale, and TPO, combined TPO, that's about 50% of our business, and the other 50 is retail. So how's that for balance? I mean, that's balance. So our percentage of people that do business with us, we actually have more share within our own company that's wholesale than the actual market share in the industry, which is, between 16 and 19%. So we have found balance. We think that it's different business proposition. Some people just want to originate. They don't want to run a company. They don't want to be in charge of everything. They don't want to be the cook, chief, and head bottle washer. Like they just want to eat, or they just want to cook. And we have a platform for them. And that platform works in harmony with our broker platform. And the broker platform is fantastic, and it's getting better all the time. And you get to decide deal by deal whether you want to use us, right?
But how does it benefit? Like if I give you a loan, right? So do I have to be? Do I have to worry about like those clients are not going to come back to me?
So client retention is my absolute favorite issue that the Brawl and AIM and Anthony Casa team have brought forth as a discussion point in this industry. Anthony Casa and I first got on the phone about 2.5 years ago, and he was calling all the lenders and calling everybody a bad guy if they had a retail channel.
So you got his attention.
Yeah, and he got mine, and but I'm like we're not bad guys, and I actually agree that is the originator's client. That is the originator's borrower. That is the local relationship. That is that originator in the community. That's their client forever. And I never wavered on that point. And so how we go about delivering on that belief is when we service a loan, which is about 10% of the time. Okay.
Oh.
Not all lenders service, by the way.
Mm-hmm.
Okay. When we service the loan, we do everything before the whole Brawl movement started. For years, we serviced loans on behalf
I did not know that.
of all originators. But it's about 10% of our book.
Okay.
Okay. And when we were smaller, it wasn't a big portion,
exactly.
But we've always had that core belief that borrower belongs to the originator. And so if the borrower ever called in, they asked for a payoff, we would then turn around and call and give it to the originator, whether a broker or not.
Okay.
Okay. We've always done that. And so what's cool about this discussion point in the last 2.5 years is there's better technology, right? So we use Sales Boomerang. Shout out to Alex Kutsishin. We've been using them about 1.5 years. And we, on the loans in our portfolio, we monitor triggers on behalf of the brokers. So that was us stepping up our game in my conversations together with Anthony Casa and saying, how are you going to protect the borrowers? And so if a loan is in our portfolio and the borrower has their credit pulled, or if they have a new debt that shows up on their credit report, we get a trigger.
Okay.
And then we turn around and we...
That's like stalking.
Yeah, I know. It's crazy. So here's the other thing. So we monitor 3 other things, right? And this is for loans whether are in our portfolio or not. Okay. If the borrower lists their home for sale, if there's an equity alert on the property,
Okay.
or if there is a life event. People like to say the 4 Ds. I think it's really I think it's 6. I made up 2 more. Can I be so bold to say I made it up?
Please.
So it's diapers, diamonds,
Okay.
debt, divorce, downsize, and death. So I added downsize and death.
Okay.
Right. So
I took the diapers. I'm like,
yeah, if you have a kid, right? You gotta get a bigger house.
That's true. That's true.
You get married, you gotta actually buy a house. So we monitor the 6 Ds, and I did make that up just for the record. So I'm taking credit for that.
Ds.
That's it.
There you go.
So we monitor those things. We also watch internet search engine behavior. And we make sure, if borrowers,
That's a lot of...
mortgage is near me, interest rate, how do I know if I'm pregnant? The engine will, the algorithms will put those search data together and go, hey, here's a 90 out of 100 score. This person's probably going to buy a house.
Oh, wow.
So,
and you give that to the broker.
Absolutely.
Wow.
Yeah. And I know that
nobody knows that.
I know they don't because we're not shameless self-promoters and maybe we should be, but
that's what
but
I'm
we're
saying.
still growing anyway, so slow and steady wins the race, I guess, whatever race that is. But
So you practically created a platform. Whoever the originator is stays with that originator. Is there like a certain percent? I mean, not certain percentage, but certain years limit or
No limit.
no limit.
No limit.
Okay, because I know that Anthony and everyone at AIM that he's been communicating, he said their agreement is only within 3 years.
I don't know. I'm not familiar with that agreement, but
Or maybe I misheard, but I think when I talked to the company that when I was texting you, remember that the Skynet company,
Yeah.
and then someone says hi, and he explained it, and he said 3 years.
So one of the great discussion points that's been out there is selling with a non-solicit, and I know that some lenders do offer a non-solicit, and I think United Wholesale made that the most popular. I think they're the main ones that do it. I've heard 3 years. I've heard 2 years. I don't know exact their language, but I've even heard 12 months. I don't really know. Like I don't know if it goes by product.
Yeah.
But so that's a very that is actually a very interesting discussion because.
But for you said it's no limit.
Well, a non-solicit is different. And
okay.
So I actually like what they do, and let me give you some just really inside baseball kind of low down and behind the scenes what's going on with that discussion point. So. Mortgage bankers are afraid of that concept. They are afraid that their servicing portfolio is at risk if they don't get to be the end all be all of the retention.
Control, yeah.
And that is changing. I mean, that game has changed, and so I'll just say that a lot of the big buyers on the back end, they're really rethinking how they want to do an offer and who they want to partner with and whether they want to be aggressive.
Does it affect
with
your
retention.
business?
It does. So I'll give you an example. When Anthony Casa and I first started talking, we were selling a lot of loans to Freedom. Mm-hmm. And, probably 10 to 15, maybe 20%. Mm-hmm. And the light was really, shown on them about how aggressive their retention team is. Mm-hmm. And they have a great business model. I mean, Freedom is a fantastically run lender. I mean, their portfolio is like, they do a really good job, and that's their model. And with this whole conversation about non-solicit behind the scenes, other investors came in and took over that specific product mix that Freedom was really good at, and they don't do the retention like Freedom does on that level. And so, some of these aggregators that buy loans, they're at like 15% retention rate. So why not just let us monitor it and then give it back to our originators that gave the loan, to them in the first place? I mean, you see Home Point has that model out there. They're doing a good job of pushing that. Willie Newman and Phil Shoemaker, really great guys, and they're making a big push on the servicing side. I think the game is going to continue to change, but I think at the end of the day, if someone calls from a retention team and they call your borrower, it's like a trigger for your borrower to call Lil. From what I hear, about 95% of the time, if a loan ends up in a portfolio that someone else has a retention team, and some little random dude on a headset calls, hey, what about me? Let's see refi. They go, hey, Lil, like you did my loan. Who's this person calling me? And then you work to do the deal. It's like they are your trigger and alerted you of the lead. And so I know that that discussion is going to continue to evolve. And I think that as originators get better at retention and staying in touch with those leads after closing, that I think that the aggregators, even if they're servicing the loan, I think they're realizing how good front-end originators can be at keeping those loans coming their way. And so that discussion is an ongoing discussion, which I think is only going to get better for all originators.
Oh, yeah. Well, I'm glad because that makes me feel better.
Of course.
Because like I said, a lot of people like, oh no, because they're afraid because you guys have a retail side, right?
Sure.
So if you
Well, our retail has never gone after our broker's business.
that's what I'm saying. So
Yeah.
because you separate your own platform.
Yeah,
So-
that was a myth about our company.
Exactly.
But-
That's
but-
why we're breaking this right now.
Right.
So yeah.
Well, remember when Brawl was started, any lender with retail was a bad guy. Mm-hmm. But that's
Oh,
not true.
wholesale.
Right. But that's how it started, right? Which some can say it was a miscommunication. If I were to have an ego and feel so offended, I could say it was an outright lie about my company. But I think it was just a delivery of the message. Our retail channel does not go after our brokers, borrowers. So I think where the big offenders are, you've got some of the names out there like Quicken. If you look at Anthony Casa when they started that movement, he had Garden State Home Loans. He's been very vocal about his story, and they sold a lot of loans to Quicken, and they were churning his Garden State Home Loan clients. He was running a non-delegated correspondent lender, and they were churning his clients. So, yeah, I mean that he was just fed up with that, and some of these lenders are worse at that retention than others, and again, our retail channel makes PRMG stronger as a whole, which also serves our wholesale brokers. And so anyway, I just I love where that discussion is going. I'm in.
It's a big discussion
Of
that
course.
it's going to be never ending because the fact that a lot of people actually they serve like, hey, you got paid, so it's our client now. It's just like given the right to for like eternity,
Right.
and which is not true because each borrower has a personal connection with us, so it's kind of hard to let go. So, and I know some people actually who thinks
And you know what's amazing is like, if we could, we would service 100% of our loans. But you have to understand how much cash
Turn
that
around,
takes.
yeah.
Is so much cash. And
can
so
imagine.
when you look at all the servicers, they've all gotten money from an equity firm or a REIT or a bank, or they've sold control and ownership of their company. I mean, look what happened with Stearns. I mean, what a private success story with Glenn Stearns and how he came up through Baltimore, worked his ass off, built this thing, and then he took out debt, he took out sub-debt to be able to do the servicing play. And the people he took sub-debt from, they end up kind of weaseling their way in there and then taking over.
Yeah, exactly.
And, it's just...
I felt bad.
Yeah, no, but, well, he's back again.
Oh, he is?
Yeah, he's putting together a company. I haven't seen it get too public yet, but I believe it's called Kind Mortgage. And,
Okay, be kind.
In Irvine, yeah. So I don't know the play there, but obviously he's an industry veteran. But my point is, if you want to be a servicer, right, that is the only 100% foolproof way to protect every client every time. Period. And it takes so much money. So unless you're just super independently wealthy or a shrewd businessman to take out sub-debt that won't come back to haunt you, if you have debt to someone, you're beholden to them in some form or fashion. So, but I think even that line of logic that I just put out there, I think that's going to evolve as well. And so, again, we're not going anywhere. We're watching how it changes, and we're picking and choosing our battles. And in the meantime, for better or for worse, whoever people think we are, we're growing. We're growing all of our channels. We think we could, if we could staff up quick enough, we think we could double this year in business. And we're still just like this small little gnat on the ass of the mortgage industry. It's like we're just not.
But you guys are original, like I said, because I mean the bottom of it is it's always people's connection. So you guys always connected. Your AEs are wonderful.
Thank you.
I have a really good AE, and
Annie
she's
Gotch.
Yes, Annie. Hi, Annie.
17.
And
No, she's 18 plus years with us. She's literally like our first employee.
Yes. She is awesome. And whenever I call, don't worry, Lil, just submit it and we'll price it, we'll get exception. That's always I hear from Annie. And like I said, that's why I feel bad, because I only call her when I have, like I said, oh my God, Annie, we're going to change that. So we're going to change that relationship. But for the meantime, I thank you for coming
of course.
to
Thank
this
you for having
segment,
me.
of course. And I think for you, my advice, I mean, you are well like, how to CEO, PRMG, but the fact that PRMG, they don't know what PRMG. I think if you just go out there or just, spit out your more promotion, I think they'll come.
Well, we're a more active member in AIM this year, and we've upped our sponsorship. And Anthony Casa and Katie Sweeney and the whole team, they do a fantastic job over there. The AIM Irvine show, AIM Activate, is coming up March 5th.
I will be there.
I am going to be on a panel.
Nice.
The Mortgage Marketing Makeover.
Wow.
And so we're gonna talk about stuff like this,
exactly,
and how to do better branding.
Okay.
And so look, again, we may not be perfect, but yet still here we are serving everybody, just trying to help.
The fact that you says that you may not be perfect, that's perfect, because there's no such thing as perfection, really. So every lender has a boo-boo hiding in their closet.
Of course.
Even UWM, they have like a big boo-boo that, you can't bypass anything. So they're on cue. If I need something like, hey, can you look at that? I'm going to expire. My rate's going to expire. Can you just clear? I can't do that. So you got to wait for your turn.
Yeah. Well,
so with you guys, I'm like, Annie, okay, we'll get it then. Hey, and next thing you know, like an hour, it's cleared. So,
well, we're just good old-fashioned service.
That is pretty awesome. Anyway, thank you so much.
Thank
Here's my
you.
guest, my awesome guest, Kevin Peranio from PRMG.
Thank you.
Send him a lot of loans.
Thank you so much. Appreciate it.
Thank you. Wrap.